Escrow seems to be a dirty word that a lot of people don't seem to understand, but as you're moving through the real estate process, it has a couple of different meanings depending on whether or not we're talking about the escrow account with the title company or the escrow account with the lender. But what we're going to talk about today is escrow items that are in a home loan. You're planning on moving to Flower Mound, right? You're relocating. You're from out of state. You've never heard of this whole escrow thing before, which is not unusual. But you're going to hear this all through the process. So when you're working with a lender, they are going to ask you, if you put down less than 20%, they're generally going to ask you to pay monthly portion of the homeowner's insurance and the property taxes. And property taxes in Texas are fairly significant. So the reason that they do this is to protect themselves, so that if there's a foreclosure, that they're not the second person in line to get paid. The taxes would likely be first, and then the lender would get paid. So it's generally those two items. Now, HOAs and other items are not included as part of your escrow. And I just went through this morning. I had a closing. I tried to explain it to the buyers, but it didn't seem to resonate until we actually got to the closing table and the title company. When it became more of a reality, the title company was able to explain it as well. But the escrow accounts, when you're buying, so let's say we go under contract, right? And you're going to put down earnest money, which is essentially a deposit. It's a good faith deposit that you're going to move forward on the house. That would go into a escrow account, which is a third party depository. Essentially, it's a group that will hold that money separately from any other accounts. So, but that's not what we're going to talk about today. That's a whole nother subject. We're going to talk about what it means in the home buying process. So when you're borrowing money, and you're buying it either from a bank or directly from a mortgage lender, the escrow account is where the lenders deposit a portion of your mortgage, your monthly mortgage payment, that will cover your insurance premiums and your taxes. And they usually, by collecting a little bit of this every month, it reduces the potential of you falling behind if you were doing it on your own, and the obligation. Because let's say that you get busy, you don't have your insurance in escrow. Well, you know what? You let it lapse, you let it cancel, and then what happens, right? The same thing goes for taxes. So that's the purpose behind that. How does it work? Well, when you get a loan for the mortgage, even though your insurance premiums are paid annually, right? And your taxes in Texas are due by January 31st, and they're paid in arrears. So this is 2025. On January 31st of 2026, the taxes for 2025 are going to be due. So what these mortgage companies do is, at closing, you're going to see, this reduces the risk for the mortgage lender. And you know what? It's just kind of the cost of doing business when you're working with a mortgage company. If you're paying cash, none of this matters. You'll pay all that stuff separately. But this is only when you're getting a loan. And this applies to FHA, VA, and conventional loans. Especially on a conventional loan, if you are putting down less than 20%. If you're putting down more than 20%, some of this stuff can be possibly negotiated, but don't quote me on that. You have to talk to your mortgage lender. So basically what happens is you're going to have your mortgage payment, whatever it's agreed with you and your lender based on your interest rate. And then you're going to have the taxes, a portion of that, and it's going to be split up over 12 payments. They don't know, the mortgage company does not know exactly how much your taxes are going to be, because the tax bills don't come out and get finalized until the summertime. So they're going to estimate it based on the previous year's taxes. Same's going to go for the insurance. Now, there could be a difference at the end of the year, but we're not going to talk about that right now. But if you have unpaid taxes or unpaid insurance, that could lead to a lien on your house. And if you go through foreclosure, that's a bad deal for the mortgage company that produced the original loan. So it's an incentive for the borrower to kind of keep up to date and on these non-mortgage homeownership costs. But there's some downside to this as a borrower. Your lender usually requires you to keep a minimum balance to protect against any increased costs. Like their taxes generally don't go down, they generally go up. It's not a rule, but it's a reality. And the same for homeowners insurance. So the rule for most lenders is they want at least 2 months worth of escrow for the insurance and for the property taxes. So that would be 2/12, right? At today's closing, they requested up to 3 months. But here's the deal. Today is December 11th. The first payment, mortgage payment, wasn't going to be due until February 1st because you get a month break before you have to start paying. So just to recap, you're paying your mortgage company will pay directly to the insurance company, and they will pay directly to your county appraisal district. So in Flower Mound, we're under Denton County, and so any payments that I make toward my escrow payment on my home loan, they're going to take care of. I will still get a bill, because you will always get a bill. You'll still get a bill for your insurance. When your insurance comes around, you might want to take a look at it and see if you can shop it around. Just because you have it with one company does not mean you can shop it around. You can't do that with taxes. You can only operate in the county that you're in. So this would be in addition to your principal, which goes directly to pay down your loan, and interest payments, which are part of your original loan. So you're actually paying, a couple of different things. You're paying principal, you're paying interest, you're also paying taxes, and you're paying insurance. So essentially 4 things. And then if you have an HOA, that gets billed separately. And the escrow company holds this money until the end of the year when everything is due. I hope that makes sense. Your escrow payments, and again, your escrow payments can be adjusted up or down. Just depends on whether you have a homestead exemption, which is for another class, another video in Texas, which is a great deal, which would cap your tax rate at maximum of 10% increase, plus some other stuff. And your insurance, again, I personally would constantly shop that around and see what kind of rate you can get. I see some extraordinarily high rates, and I see some very reasonable rates. If you also have to pay mortgage insurance, this is another thing. If you put down less than 20%, I don't particularly care for this deal, but it's one of those deals that it's just the cost of doing business. If you put down less than 20% on a conventional loan, it's called personal mortgage insurance, PMI. Once you get past that threshold of 20%, where the value is, 20 or more than 80% of your home's value, then that PMI goes away. It usually takes, in this scenario, it was going to take 8 years. You can always add more money to your principal and get that thing to go down a little bit more. But before closing, the escrow agent, he or she is going to provide you with a settlement statement. And this statement is going to itemize all the final closing costs and the fees that come with your home loan, including all the prepaid items and the money that's going to go into the escrow accounts. And just to review one other thing, HOA fees are not part of the escrow account. Now, you will get credit If you're in an HOA, for example, I bought a house in July or I bought a house in September, let's say September. If you bought a house in September and there's HOA fees, the current owner is liable for those HOA fees up until closing day, and then you're responsible from whatever day that is in September to December 31st. And then on January 1st, or maybe a little bit before January 1st, you're going to get another bill for the whole year. Generally, a lot of these HOAs, some of them get paid quarterly, some of them get paid annually. It just, you and your realtor, or you and me, are going to have to research that and find out how that's set up. But you can, there can also be a supplemental tax bill if there's like a shortfall in the escrow, or if there's an overage, you might be able to get a refund. But if there's a shortfall from the previous tax year, then you'll have to address that maybe with your mortgage company, or in new construction there may be a change of ownership, and a lender can't control a lot of these things, but those are the basic items of what an escrow account is for when you have a home mortgage. And I hope this has been something of a help. If you like what's going on here, please subscribe. It will really help the channel. I'm Chris Hooper, Chris Hooper Realty. Can't wait to see you next time.